This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I'm really lucky with this podcast. It's like going to school on a regular basis. Back to college, so to speak. High school, grade school. Well, I guess actually, I might not get the opportunity to speak with a Daniel Kahneman in grade school. But I'm fortunate. Of course, you, the audience, is fortunate as well. But it is so much fun to have so many bright people come on this show and give wisdom. Now, sometimes for 30 or 40 or 50 minutes, maybe not all of my guests give 100% wisdom the entire conversation. But what I love about my guests is they always have something. There's always something unique in what they bring to the table. Most of the time, I don't expect it because I don't do pre-interviews. We just get on and go. Usually I take an 8.5 by 11 sheet of paper. Maybe I spend 3 or 4 hours for each guest, depending. Sometimes I have to read books for the guest. Actually, I do read their books. But I'll just make notes. I just put notes on this one sheet of paper, and I try to have a dozen or so big picture issues that we can talk about. That's kind of my process. And then I just let it flow. Let it go. Let's see what happens. Let's see what we can make out of a conversation. You know, sometimes guests are wide-ranging and wide-opening. Sometimes guests are a little more nervous. But usually it works out well. Like I said, usually there's that one thing, that one really salient point that a guest says on my show where you just go, wow, I didn't think about it that way. Or, oh, I didn't know that. Or, wow, that's such a wild perspective. So much fun. And my guests aren't random. There's not for lack of order. I curate this. I know what I'm looking for. I might not know who I'm looking for necessarily all the time, but I know what I'm looking for. That bold, big insight. Doesn't necessarily have to be in trend following, obviously. In the last 6 months, I've brought on a lot of different guests. But they always relate tangentially to what my core is. It's always related. It's right there in the sweet spot. I asked this on a podcast recently, and I want you, my audience, to do me a favor. If you like what I continue to do on this show, please go out there on iTunes and write a review. This whole ranking process and how iTunes ranks and whatever the hell Google's doing in that particular week with their ranking system. But I just want to continue to pull really smart people. And pulling really smart people is somewhat playing the game and somewhat making sure that my iTunes page at Apple has the positive feedback. Because I get so much more positive long feedback in email. It's amazing. I get emails that are page long all the time about my podcast. I just want people that like my podcast to go write those on iTunes as well. I mean, I usually post these on my blog, but go out there, tell the world. Don't just tell me. Tell everyone if you like it. That I can continue to use that leverage to get really bright people to come on my show. My guest today is Roland Austrup. He's Chief Executive Officer and Chief Investment Officer of Integrated Managed Futures, part of the IAM Group out of Canada. Roland's firm comes at trading from a slightly different perspective. Very systematic, but he also uses fundamentals systematically. So trend following by nature, fundamentals, but all systematic. He brings an interesting perspective. I hope you enjoy. Roland, here's where I want to start today. So you're the CEO of a significant managed futures operation, but it didn't start that way. It did not start that way. So what I would love for you, since we're going to talk about the style of trading that your firm is, the quant style, it's a combination of fundamentals and technicals. But first, I would love for you to kind of place. A long time ago, were you a guy that was reading about Warren Buffett and Charlie Munger? Were you always a quant type thinking guy? Tell me early on how you evolved.
Well, that can be a long story because my story goes well back to the 87 crash when I was still at school. And that's when I became interested in the markets. The reality is I did what's called that bit of a taste test of life in university. My core background was in sciences, so I always thought along the methodologies of a scientific methodology. Ultimately, I actually ended up with a degree in philosophy and then was in the process of doing a post-secondary degree when the market crashed. And that's when I became quite interested in the markets. Just had the intuition that two thoughts. That's where I wanted to be. And the second thought was that if the industry's in stress and people are leaving, this is probably the best time to join because I'll rise up pretty quickly. I canvassed the street and Scotia McLeod hired me in Canada. I started out trading currencies, doing mostly hedging work, and then moved to BMO Nesbitt Burns in 1991. Spent about 6 years there. Saw the growth of the alternatives industry and then specifically managed futures, sold my business that I developed at Nesbitt to start my own shop. And I don't know if you remember this, it goes way, way back, but I started a shop called Aero Capital, A-E-R-O. And really that was nothing more than a long-term trend follower. And one of the influences behind that is a name you would recognize, which is Ed Seykota. I went to one of Van Tharp's conferences where Ed Seykota spoke, and that really hooked me onto the long-term trend following approach, and it was really the backbone of the company I had originally started, and that still has a lot of influence on the company we have today. Fast forward a number of years, I had some fairly good success, as many emerging managers did in the late 90s, tinkered with my own system in 99, 2000, went flat to slightly negative, which really took away a significant amount of interest in the business, then rebuilt it, and that's when I was approached by my current significant shareholder, which is Integrated Asset Management. Parallelly, they had built a $2 billion asset management shop, and part of that was that they were the exclusive distributor for Man in Canada and raised about $500 million. Well, they knew full well that at some point in time, Man would want to stand on their own 2 feet in Canada, and they also wanted to get into managed futures. So they struck a deal with me. I came on board, built a team, did research. When they separated from Man in December of 2006, we were able to launch our new program at the beginning of 2007, which is the IMFC Global Investment Program, which I think you've seen have the results for.
Well, I'm not going to let you get away with getting us 20 or 30 years in about 20 seconds. I know you would like to. I know you'd like to let it, but let me jump back on one thing. You mentioned an influence. You mentioned Ed Seykota, and I think one of the interesting things about Ed is that sometimes maybe people misinterpret. They see kind of a whimsical nature. Maybe they think he's just being cute. But I tell you what, and I'm sure you're like that with your understanding of him. For those that know what's going on, that man brings a real power of delineating how things work and how one can take advantage of opportunities. And I'm sure since you mentioned him, he must have really had an interesting effect on you.
He did, although to be truthful, Michael, we never really kept in touch over the years. Only recently did we get reacquainted. I went out to visit him and had a nice lunch with him less than a year ago. But he had certainly a profound impact in the beginning, which continues today. And again, as you mentioned, I think he distills things to their most basic facts, and that brings a real clarity. And I would say certainly there were two things that influenced me most about Ed. One was the focus on long-term, which still is in our program today. If you look at the average duration of a profitable position, it borders on 2 years. But the other one was more the mental side of it, really removing the emotion from the equation and staying very objective and systematic in terms of how you build, operate, and handle the results of your system.
Let me jump into where you are today. There's a bunch of topic areas that I want to touch on. But the first thing I think I'd like to touch on and going through and understanding more about your firm is a combination of price-based trend following along with fundamentals. So my first question is your use of fundamentals a systematic use of fundamentals, or is it a discretionary use of fundamentals? And I guess at the initial stages, it has to be discretionary decisions. But I'm curious if your use of fundamentals in your ongoing trading is systematic or something else.
No, it's entirely systematic. Fundamental information is just another input that we build into systematic models. And I mean, the challenge with the manager, particularly if you become intimately aware of your system, is most good managers can look at the markets and have a sense of what their systems are likely, how they're likely going to be positioned. But it's very important, again, to maintain that objective nature, to be able to codify, test, and then manage the day-to-day process in a systematic fashion. So that's one of the axioms that we adhere to, is the fundamental information has to be, we have to find a way to make systematic rules based on that information, as opposed to having opinions that guide the decision making on a day-to-day basis.
Let me drill a little further on the systematic notion. So you sit down with new clients, and perhaps it's a very sophisticated client, institutional client, high net worth, I don't know. But systematic can still be a frightening type concept for some people. They think you've got the plane on autopilot, something could go wrong, there must be a pilot. How do you, when you sit down to explain systematic trading, how do you get the client, how do you get the individual to understand why this is a benefit and not something to be afraid of?
I think at the end of the day, what we really say is ultimately what we're capturing are market fundamentals. The systematic nature of the trading is really just a calculator on steroids. By designing systematic strategies, we can do many calculations that we just couldn't do in real time ourselves. But they're all based on fundamentals of the market and our opinion about how markets behave that we've researched and tested. So there's nothing scary about systematic. In fact, it brings an operational efficiency that's important. It's a tool to be leveraged by a good fund manager. I would argue that there's something a little bit more dangerous about managers that don't follow systematic strategies, because that's the real black box. When you can't see what's going on in someone's head, and you don't know what's going on, that's a black box. You don't know what's happening. I can explain very easily all of the basic concepts that our models are running. So while they're managing, significant input and doing a significant amount of calculations, it's really an operating efficiency only that it brings to the table. It's not, the systematic systems are not themselves gleaning any insight, rather they're being taught by us, and they're bringing an operating efficiency to the process.
I should add, without naming any names, I think the audience will be familiar, but one of the largest funds in the world, if not the largest, as far as I understand, I've seen him say that we use only fundamental information, but it's only systematic. So there you have one of the largest, if not largest funds saying, hey, we're 100% systematic.
Well, true enough, and that makes a lot of sense. I mean, any significant business in any industry typically only succeeds because of very strong operating processes and systematic processes, as opposed to ad hoc decision making.
Let me jump around on you a little bit. Let me go to the idea of managing risk. I've seen you talk about the return to risk profile. When you think about managing risk and you utter that expression, you're talking to someone, you're explaining what you do, what do you mean by the phrase managing risk?
Well, there are many types of risk. The main risk that we're attempting to manage is not the probability of an adverse outcome, but how much we will actually lose in that outcome. In part, there's a bit of managing expectations too, and I wouldn't equate volatility alone necessarily with risk, because that can be managed. The real risks are the shocks that can go wrong. However, we do try to keep volatility also within a very tight band, and that's really more to manage expectations and to keep clients in a very comfortable zone.
I saw you mention targeting a downside volatility of 13%. Talk to me about the 13%. It seems like an unusual number for if I hear the number, I want to know the story behind the 13%.
Yeah, there's no magic number to it. It's not that if it's higher than that, you're exposed to stresses. Again, stress can be managed separately than volatility. The number was this, and it's actually a little bit lower than 13. It's really between 11 and 12 if you look at the actual realized downside volatility in our program. What we felt, or what I felt, was that investors are comfortable with equity-like volatility. And if you look at our standard deviation, it's actually a little over 16%. And so we're targeting a level of downside vol that will result in an equity-like overall volatility. And it was nothing more complicated than talking to clients and knowing what they were already comfortable with. And it was also the number that I was comfortable with for my own money. So, and again, our concern is not in managing volatility. Good volatility is a good thing. Our focus is on understanding when volatility and correlations are conspiring against you, and it shows up in your downside vol.
Even though you're kind of restricting yourself on that downside volatility, that does give up some of the upside too, or no?
It does, but again, the beautiful thing about managed futures, certainly in the managed account format, is clients can gear up their investment to whatever level of risk that they desire. But a large part of our business is in offering funds to the retail advisor, either as you know, with Attain in the States with a Reg D fund, or up here in Canada with a prospectus mutual fund with Aero Capital. But to go after that market, and to really penetrate that market, you have to position your product in such a fashion to target a risk-return profile that their clients are already comfortable with. And again, in the managed accounts, certainly clients can gear you to whatever desired volatility they would like to have.
Let me slide back to managing risk for 1 second. I've seen you make the statement, and it's a classic trading statement, but I think it's worth breaking apart for a second, because even a sophisticated investor might hear this and think, that sounds a little cavalier, or hold on, why don't you know? And what I'm getting at is, you manage the risk, the returns take care of themselves. You and I know deep in our gut what that means. I'd love for you to break that apart, though. The returns will take care of themselves.
Sure. I mean, ultimately, what markets are about is markets are a forum where exposures to various types of risk are priced. You have the risk of being a lender. You have the risk of being an equity investor. Certainly in commodities, there is risk that's priced into both the futures curve and more so in the case of currency, into yield differentials and spot movements. But the market is a place where risk premiums are established for people that take exposure. The real advantage that we as investors have is much like the advantage that an insurance company has. Whereas some people cannot expose themselves to risk, we can take on risk and diversify it across multiple markets or ways in which we can look at risk. Risk is priced into the market, and so the return of that, that pricing is the return that's there, and that's why returns take care of themselves in the sense that the return is priced into how risky that exposure is deemed to be. So our job as a manager is to understand how to spread risk as widely as possible and how to manage things when they don't work out correctly.
I've seen you make the statement also, or not you personally, but I've seen your materials, the idea of talking about trading trends and not market noise. When you talk about market noise, are you referring to other shops, other firms, other individuals that are trying to trade a high frequency style trading or something else? Or are you just delineating clearly that you don't want to be in that very short-term space?
Well, I don't want to be in that short-term space. I believe there is a lot of noise in the market, and I believe it has increased, not just from the high-frequency managers, but generally by the growth of the industry. And we've been able in our own research to demonstrate that fact. And we've demonstrated very simply. We were able to look at market data, and we find that over longer-term time horizons, markets still generally move from point A to point B, but the daily standard deviation in that time horizon has increased. And we think that that's due to more participants. Our focus has always been, and this goes back to probably, some of the insight from Ed Seykota. There are three things we know about trends, or we think we know about trends. One, they're not really foreseeable immediately. I mean, you might have markers that tell you that it's more likely that something's going to go up or down, but no one knows what's going to happen tomorrow because no one knows what tomorrow's information is going to be or how people are going to interpret it. So you don't know tomorrow's trends. You do, however, with the benefit of hindsight, know exactly why yesterday's trends happened, and they're usually explainable by deep fundamentals, not just spurious market noise. Usually it's fundamentals that play out over time. And the third thing you notice about those trends is that there really aren't many active strategies that can make more money than just being on the right side of a long-term trend.
Yeah, I mean it's such a simple sounding thing, and I think even people that are not exposed to higher levels of market trading and understandings, they kind of get the idea. Oh, the trend is going that way. Everybody, for example, just talking silly here. For example, everyone's buying an iPhone. I mean, the average individual knows what that means for Apple stock. I'm not saying that's a strategy. I'm just saying the idea of trend and being on the right side.
Most of the growth stories of yesterday, you can look back at and understand why they came about. Everything from Apple to the emerging market in China growth story, its impact on commodities.
I think one of the interesting things also that you guys have done is using the phrase equity-like returns. And I'm assuming that gives you the opportunity to say, hey, hold on. And I'm not, let's say you're dealing with a skeptical investor, but when you use the phrase equity-like returns, I assume you're challenging investors to, if they're going to have a preconceived idea of what might be a negative towards your type of strategy, you want them to look at what the volatility can be on a buy and hold perspective of the S&P, for example.
Well, that's right. I mean, we certainly don't think we're going to have equity-like peak-to-trough drawdowns because of how we manage risk, but we certainly think that we will have equity-like returns and volatility. And I think that's really what we're trying to tell investors is, look, you can get similar absolute returns over time with our strategy, but it's in a completely different way. Uncorrelated to equities, and also some better risk management that will to some degree help mitigate the large peak to trough drawdowns, but will not perform in other markets, for example. I mean, there are other environments that, the activity of buying and selling when there's no directionality, that's kind of our nemesis and where we struggle.
If you look at trend following performance, CTA performance, managed futures performance, however you want to couch it, in the last bunch of years, there's been some variable performance, to say the least. So some managers have had some downs, some have had some ups. It's definitely not been the prettiest period, for example. Now, I would quickly look at the last 3, 4, 5 years and say, well, gosh, when you have a United States Federal Reserve involved in the marketplace like they are, all bets are off. I can't really explain what's happening, but I do know that their level of involvement is unique and it's unprecedented. How do you feel about the last bunch of years of performance? And perhaps if you were explaining to investors how you perceive why there's been some up and down performance volatility?
Well, the why is pretty easy. I mean, people dwell on the last 3 or 4 years. Quite frankly, that's a fairly normal period of performance given the environment we just went through. And you can distill it down to a very simple fact. I mean, and again, this is one thing that I say are explainable with the benefit of hindsight. We didn't know how things were going to evolve during the aftermath of the global financial crisis. We only know how they did evolve. And so what you really had is you had central bank intervention or involvement in the market that was attempting to put a floor on how bad things can get. And on the other side, you had a natural deleveraging process that was preventing a lot of growth in the markets. And so when you put boundaries on support and resistance, it's going to be very hard for directional strategies to work. But that didn't necessarily have to turn out. I mean, quantitative easing could have had adverse consequences. It could not have worked. There could have been other crises. And that's why investors need to continue to maintain their exposure because you never know what could have happened, how badly it could have unraveled. And certainly had that happened, we would have done quite well. Anytime you have a crisis, in the immediate aftermath of the crisis, you have that lack of directionality and managed futures underperform. But after that, you really do tend to get a normalization of industry performance, and you see managed futures reverting back. You can say, well, why did the Fed do what they did, and was it appropriate? I actually fall into the camp that it was appropriate in terms of what they were doing, because effectively what they were trying to do was re-engage the economy. And to do so, you have to do two things in the interim to get the economy to self-start. You do have to repair balance sheets and create an environment for things to self-repair. And at the same time, you have to remove fear from the market. And I think they go hand in hand. I mean, repairing balance sheets, even though you're, inflating valuations, does have the effect of removing fear if you don't have another crisis. And certainly those things all came to pass. And if we look at where the industry is today, we're in an environment where you can see that the fear premium is gone from the market, and you can see that because volatilities have collapsed across the board and correlations have dropped across the board. So you don't have risk on, risk off anymore. Rather, you have markets responding to their own fundamentals. So you're seeing those markers that I would argue are very, very supportive for the industry going forward. Much like in 1980, the environment of low equity valuations in high interest rates is a very good recipe for a buy and hold approach to traditional investments. Well, an environment of very low volatility and low correlation across markets, particularly when you've got probably higher real volatility in terms of geopolitical volatility, those are generally very good markers for the performance of managed futures going forward.
I should interject here as I ask you some why type questions and we discuss the economy a little. Your trading strategy doesn't have you sitting back pontificating like an economist to try and guess what's going to happen. Your trading strategy is going to grind through and take its actions based on the philosophy your firm has for that trading strategy, regardless of what might happen next.
That's correct. Yeah, for sure.
But that's a big thing to understand, because I think sometimes when quant managers, which there's nothing wrong with having an opinion, but I think sometimes when quant managers have an opinion or want to help people to understand or to explain an environment we're in, I think it's always important to come back and say, but you know what? Our system's going to take this into account whichever way it goes. We're ready.
Well, I'll give you a perfect example for that, Michael. Let's look at the U.S. dollar. I have personally, and I've been a big U.S. dollar bull for a long time. If you go back to, my first public mention of it, it was in August of 11, where I said, the retirement trade that's in front of us is just going long the U.S. dollar. That was a personal opinion. That wasn't our model. That was a personal opinion that very likely you were going to see the U.S. Fed be the sort of first mover ahead of Europe in terms of challenging or dealing with the problem of the global financial crisis, and probably recovering quicker and having some relative economic outperformance going forward. At the same time, on a purchasing parity basis, the U.S. dollar was cheap, and the U.S. has other advantages, lower cost of manufacturing vis-a-vis Europe, and that because of cheaper energy costs, and doesn't have some of the structural integration issues that Europe is having. But the U.S. dollar did not materially appreciate until recently, particularly against the euro. And why is that? And that's because of an additional factor that was very hard to see. A lot of investment flows started going into Europe that were chasing the higher yields of peripheral bonds and also European equities, which hadn't performed as strongly as North American indices. And so you had this huge unhedged flow of investment assets into the euro, which drove it up, even though my personal view was that it would go down. So our models effectively were able to participate in that rally before eventually getting short the euro against the US dollar. That's the importance of a systematic model. Markets are far more complex than we understand, and there are additional factors at play sometimes. And your model will be able to recognize that, whereas you might not on a subjective basis.
Let me shift back to a big issue in terms of the overall trading strategy philosophy. You guys trade about 60 markets?
That's correct, 63 markets.
Very broadly diversified, right? Currencies, agriculturals, interest rates, you name it.
With a skew towards commodities and currencies, they account for about 70% of our risk exposure, with the remaining 30% in traditional asset exposures.
Talk about the type of return stream from your style of strategy, that correlation that's pretty close to zero comparatively to being long the S&P. Talk about, I'm the new investor. I'm the high net worth individual. I'm the institutional investor. And I want you to explain that idea of the return streams and the lack of correlation to the traditional style, long only equities, and why that's such a benefit going forward when we just don't know what's going to happen in the future.
The simple fact is that even after a period of poor performance for the industry, we are annualizing out at 8.55% per annum from February 07 until present, with a worst drawdown of 20% and with absolutely no correlation to the equity markets. A 20% inclusion of that in any equity portfolio, you're going to see a material improvement in return. Certainly there's an improvement in return of upwards of 100 basis points or so, but more importantly, your volatility decreases by 300 to 400 basis points. And your worst case drawdown is about 1,100 basis points less than it would be if you were just invested in equities. Very simply, we provide opportunities that are uncorrelated equities. And the importance of this is no different than the importance of an insurance company being able to spread its risk across a number of assets. The ability for an investor to access multiple positive return streams that are uncorrelated spreads risk. That is the greatest tool that an investor has at their disposal, is the ability to find uncorrelated strategies that all offer the opportunity for meaningful real rates of return over time.
What do you think about some of the larger institutional funds out there? I think CalPERS is one of them that are leaving some of their hedge fund type investments. That means they're going to be leaving exactly what you and I are talking about right now. And I assume that means for many pensioners out there, they are going to be left to the mercy of a long-only strategy, and that's it. And if for some reason or another, a major economy like America, the equity markets ever look like Japan's, that's not a good thing to not have that non-correlation diversifier inside your portfolio, is it?
Well, no, you're absolutely correct. Now, I don't know what the thinking was at CalPERS. It looked to be more size-based than anything else, but you have to think that they were influenced as well by recent performance and making the classic mistake of selling the bottom. There are other ways you can get diversification in more illiquid things, but you're absolutely right. Managed futures and macro, I would argue, because I actually view the two as synonymous today. Maybe they weren't 20 years ago, but I view them as somewhat synonymous today. The thing that ties those two strategies together is they're both active directional strategies with risk management. Absolutely essential as a real diversifier during periods of stress. They are the one strategy that has conclusively demonstrated their ability to perform in every major period of stress from the early 1980s until even now.
It's interesting you bring up the idea of managed futures and macro and saying that perhaps 20 years ago they weren't the same thing, but today they are. I might even make an argument that maybe we didn't know for sure they weren't the same 20 years ago, because if you look at some of the biggest macro names, some of them perhaps not active today, but Paul Tudor Jones is still active. And if you go back through his classic lines, he sounds like a systematic trend style manager. Louis Bacon, Bruce Kovner, of course, Bruce Kovner indirectly connected to Ed Seykota. So you're right. I think this macro managed futures, I think there's a lot of traders out there that have been trading as trend style managers for a long time, but perhaps they've not been positioned by the market. Even a guy like George Soros. Anybody who thinks that George Soros is making his money off high frequency trading is in la la land.
That's correct. The thing that ties us all together, all of the managers you mentioned and ourselves and other managers, is that we all make our returns from large directional moves. The difference 20 years ago was that you really had two camps. On the CTA or managed futures side, you had really trend following. Medium to long-term trend following was really what it boiled down to. And on the macro side, you had fundamental macro calls that managers were making. And so the correlations were like 0.24, I think, in the 1990s between the HFRI macro and the New Edge Trend sub-index or the Barclay indices. The last 10 years, that correlation has been 0.85. And many of the CTAs, the names you mentioned specifically, they gravitated carrying the axiom of cut your losses and let your profits run. I think many of them started looking at other factors that would help them be a little bit less naive, a little bit more selective in the opportunities they positioned themselves for. And at the same time, there were some significant blow-ups from the macro world that taught a lot of those managers. If you look at the big macro guys today, not a lot of them are just ad hoc discretionary. They may be more focused on fundamental information, but they're certainly far more systematic in their approach, and momentum has become a key component of their strategy. So you've had this convergence, I think, in terms of how these managers think, which is bringing the correlations up. I would say that the guys that come from the managed futures world bring a unique edge because they never lose that one axiom of cut your losses, let your profits run. So it doesn't matter how much you believe in the fundamental model says that something's a buy or a sell, you'll never let that fundamental model be overridden by losses. You will always cut your losses and let your profits run. And I think that's a unique edge that CTAs and people that come from the managed futures world bring to macro strategies.
I wonder also too how much investors have influenced this macro managed futures debate in the last 20 years, because I think investors, when they get used to talking to managed futures style traders, and they hear the idea of systematic and why it's important, and essentially trying to isolate all those biases that Daniel Kahneman won a Nobel Prize for, and then those same investors talk to a macro trader, and perhaps it sounds a little cowboy-esque or a little like shooting from the hip, and perhaps some of these investors over the years have said, hey guys, why can't we automate this a little? Why is this all discretionary? I sometimes wonder if any of that's driven some of this convergence that you're talking about.
Time tends to show what works, and I think there's definitely been a demonstrated consistency of performance and less dispersion amongst managers' performance from those that are using systematic strategies, and that's very, very important. I mean, particularly from an investor that's looking to invest with a manager, they want to make sure that the manager is actually going to be true to the strategy. And I think one of the problems that the alternative investment industry has had, in the equity markets, you go one equity manager to another. Yeah, sure, you have first to fourth quartile rankings, but they're all highly correlated. But in the hedge fund world, there's a much wider dispersion of manager performance amongst managers that are sort of in the discretionary buckets than there is amongst the managers in the systematic bucket. So you know what you're getting when you invest with a systematic manager.
Hey, one last thing here. I know you've got a view on our current low rate environment, and I assume that view is that perhaps that low rate environment is going to extend out into the future for an extended period of time, and perhaps you have a feeling for how your strategies might perform either better in that type of environment. But I assume you would also say that while you might have a view on it, and I want you to explain that view, it could shift. Clearly, I mean, the low rate environment that we're in right now could shift dramatically depending on how events might unfold.
I do believe that the low rate environment will continue. I believe that we will be in a more of a sideways range for fixed income investments, and that might not provide the best opportunities for momentum strategies. And so managers that rely exclusively on that and that have a high weight to fixed income might struggle. Our models, as I said, I mean, long-term trends are very important to us, but momentum isn't the only factor that we look at. When you look at fundamentals, or you can quantify fundamental relationships, you can say something about, how to trade a market. And in our portfolio, we certainly know that the closer rates get to zero, the less likely momentum strategies are going to work on the long side. But if zero is your boundary, you can flip it around, and a contrarian strategy works where you can short bonds there as they get closer to zero, and you can effectively create a systematic strategy that can create a range. And that's what's happening right now. I mean, we have short positions in some of the bonds, for example, the German 5-year, the Bovel. We have shorts on the JGB, simply because we know the risk to zero is so low, and now the return to risk is asymmetrically in favor of shorting those markets. So in our strategy, we have other systematic strategies, I guess is what I'm saying. In our portfolio, we have other systematic strategies that can capitalize on environments that might not be conducive to trend following in specific markets. As well, though, it's the exposure to other markets, I think, that's very important. If you look at the broad environment, it's very unlikely that traditional assets are going to do well for exactly the opposite reasons for why they would do well in 1980. Today, unlike it was completely opposite of 1980, we're in a low rate environment with high valuations. That is not conducive for buy and hold. It doesn't mean crises either, and what that means is that if you don't have a crisis, those markets might not be as good for trend followers. Managers that trade more commodities and currencies, on the other hand, are likely to experience more robust opportunity sets than other managers that are more financially skewed or managers that are buy and hold skewed.
Roland, it has been a good conversation. I hope I was somewhat painless today. I hope I hope you enjoyed.
I did very much, Michael, and I hope to talk to you again soon.
Listen, where's the best place we can send people, though, Roland? So I want the audience to go check out you and your world and your firm.
Well, there are 3 places to go to for us. iamgroup.ca is a website of our company, and you can find the Managed Futures section in there to find out more information about us. But we offer two vehicles with partners that investors can access us beyond managed accounts. I mean, as I mentioned, we work with Attain in the States. They have a Reg D fund, the Attain IMFC Macro Fund. And for Canadians, we run Exemplar Diversified Portfolio, which is a portfolio offered by Arrow Capital. It's a prospectus mutual fund. So you can look up those firms and go to their websites as well, Michael.
Roland, it's my pleasure. I thank you for coming on today, and thanks for giving my audience a great education.
Okay, thank you as well, Michael, and we'll talk to you soon.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.